Yeah, it's a great pleasure to be at this conference this morning, especially in this impressive aula, which reminds me very much of a beautiful concert hall. I also would like to thank the organizers because I think we need a lot of insight from research. We need to get this policy advice because we are undergoing a major transformation of the regulatory framework for the financial sector. And also the topic chosen for this conference by the organizers, I think, was very well chosen already 1 year ago, because we see that the financial storm, which we have seen especially during the last fall, is only gradually calming down. And banks have been center stage in this crisis, and any resolution for this crisis can only come when banks are regaining financial health and also the confidence of the public again, that they are now following a more sustainable and welfare-enhancing business model. However, as Mr. De Felice has mentioned, not all banks have been equally affected by the crisis, nor have they been equally responsible for it. The main players have mostly been large international investment banks or banks that have moved away from their traditional retail banking activities. The movement towards a presumably more modern business model relied principally on the origination, distribution and trading of complex securities, on other fee income generating activities, as well as on funding structure more dependent on wholesale markets. And of course, I'm fully aware that we cannot go back to all customers making deposits. It's clear, but what we clearly see, and I will come back to this issue later, that we need more sustainable funding basis for banks. Many factors have contributed to the current financial crisis: the excessive risk-taking, the emergence of a shadow banking system, the exponential growth of innovative financial products, the inadequate corporate governance incentive structures at banks, the lack of a proper regulation or regulatory gaps, and an environment of abundant liquidity at low interest rates. Today I would like to focus basically on two of these aspects, namely the risk-taking and also the transformation of the business models from the funding side. To a large extent, the shift towards a new business model was based on innovation in the structured credit market, particularly in respect of creation of instruments like CDS, ABS, and CDOs. Common feature of all these innovations was that they transform, transfer, and trade credit risk. And one of the main consequences of the use of such instruments is that large amount of credit that were previously predominantly illiquid, such as bank loans, became more liquid and could potentially be traded in financial markets. And of course, we should not blame credit transfer risk instruments because they will play a role also in the future. They are very important, and they have been a big step in the development of the financial system. But in the future, maybe we will see this instrument at more reduced volumes, in less complex structures, with improved transparency and subject to financial regulation and supervisory structures. They will continue to exist because prudently applied and sufficiently monitored, they have a big impact, can have a big impact on financial efficiency. What is so special about the business of banking? When we look at the, let's say, a definition of banking, a bank is an institution whose current operations consist in granting loans and receiving deposits from the public. This is a definition which is not from the 1930s, but it's a different definition which is only 10 years old. So the core of the banking business includes also that banks provide other types of financial services. They transform the assets in terms of denomination, quality and maturity, and they manage these risks. They process enormous amounts of information, but why did we leave this banking model and what was the impact in the end? Let me take a brief look back in the history of banking regulation. For instance, the banking practices, which led in the end to the decision to have the Glass-Steagall Act of 1933. Basically, it was bad banking practices who led to this decision. The Glass-Steagall Act of 1933 followed an inquiry into whether commercial banks had sold unsound securities to their customers, thus converting potential bad loans into securities issues. The Act prohibited commercial banks from underwriting, holding, or dealing in corporate securities, either directly or through securities affiliates. The concerns which prompted the Act in 1933 are very similar to those currently being voiced, particularly in relation to concerns about banks' business models and the sale of unsound securities to unsuspecting customers. The Act had a global impact on competitive conditions. For instance, the large presence of major investment banks, US investment banks in Europe, can be traced back to the implementation of this Act, which separated investment banks from commercial banks. The Act also had an impact on the supervision of banks, mostly in the US, but also in other regions. Owing to the funding structure of commercial banks and the stronger links between them and therefore their role for financial stability, commercial banks were regulated much more. In contrast, investment banks were expected to be in less need of close monitoring and regulation, as they were seen to be less important from a financial stability perspective. The current crisis has illustrated how the actions of not only commercial banks and the investment banks, but also of other financial players, can have a major impact on all parts of the financial system and the economy at large. I should now focus on maybe the two factors that have changed the way in which banks do their business. First, the change in the revenue structure, and second, the change in their funding structure. With regard to the change in the sources of banks' revenue, the repeal of the Glass-Steagall Act in 1999 is a prime example of deregulation in relation to bank business models. And if we compare the regulations in place today with those 20 years ago, we see an unprecedented process of deregulation across regions and financial sectors. One consequence of this deregulation has been a global trend towards diversification in banks' income sources, namely through more reliance on higher brokerage fees and commission, more generally on non-interest income. The increase in non-interest income provides banks with additional sources of revenue and can therefore provide a diversification in their overall income. And it was seen as a progress when it emerged maybe 10, 15 years ago. At the same time, non-interest income has usually been a much more volatile source of revenue than interest rate income. And this we see on chart 1, where we can compare the income revenue structure of investment banks, commercial banks, and also their volatility. I hope I can provide, yeah. You see here for the period 2000 until 2007, the revenues of commercial banks in the US, in Europe, and also the revenues of investment banks, revenues much higher but also more volatile. And the volatility of earnings combined with the close ties between investment banks and other financial players calls for a higher level of monitoring also of the more systemically important players outside the banking system, traditional banking system. And therefore, there is one problem relating to the bank's risk management, and this applies mostly to investment banks, but also to other large financial institutions. We have seen that most risk management techniques neglected the correlations of risks across securities, as not just banks, but also rating agencies did not sufficiently internalize the growing systemic market and liquidity risks. And banks underestimated the tail risk. Similar event we had for similar development we had seen already during the LTCM crisis and also in the end also in 87 during the stock market crash. Existing risk management techniques worked well to a certain degree, but we should not underestimate how much effort has gone into the calibration of the Basel II framework during the last 10 years. They worked well at predicting small day-to-day losses in the middle of the distribution, but they clearly failed to anticipate severe losses that occur much rarer. But clearly it's exactly those severe losses that matter most, and the mispricing of risks relates to deficiencies in risk management techniques, but also, and more perhaps importantly, the existing incentives in the banking system oriented towards the short-term profitability of banks. And turning now to the second factor, the change in banks' funding sources, at the same time as the change in the sources of banks' revenues, there has been a wider change relating to banks' liability side of the balance sheet. It refers to the shift in banks' business models away from the traditional model of financing, because in the traditional model there was a heavy reliance on retail deposit, was mentioned already by Mr. De Felice, but this has been replaced by an increasing reliance on market-based sources of funding. The significant recourse to specific funding instruments, such as mortgage bonds and securitization, has made banks increasingly dependent on capital markets, but at the same time, of course, less dependent on deposits to expand their loan base. This is evident from both an upward trending total assets to deposit ratio of the largest euro area banks, this you see in chart 2a, and an increase in the loans to deposit ratio of large EU banks. To the extent that more stable retail deposit financing has been replaced by wholesale funding, banks may have become more exposed to market dynamics and perceptions, and this has created a source of instability. Element of this change in bank sources of funding that I would like to focus on is the securitization. Securitization activity did increase substantially in the years prior to the financial crisis in the US, but in Europe as well. It was not only investments done by European banks in US securities, but there was a huge increase in securitization activity in Europe as well. This you see in this chart. It has become clear that the change in banks' business models from originate and hold to originate, repackage and sell also had significant implications for the stability in the end. The original idea that securitization would disperse credit much better and would make the system more stable did not work out as envisaged. This stems from the fact that the same instruments that are used to hedge risks also have the potential to undermine financial stability by facilitating the leveraging of risk. There were major flaws in the actual interaction among the different players involved in this process. This included misaligned incentives along the securitization chain, a lack of transparency with regard to the underlying risks of the securitization business, and the poor management of those risks. There was a dramatic increase in the complexity of these products compared to prior to the crisis, and this was basically also due to misaligned incentives and investors' search for yield. If we look at the huge amounts of documentation which is necessary also to make the valuation and risk assessment, it's clear that some of these products have become too complex. In contrast, if we look, for instance, at the covered bond market, this has been much more sheltered from these incentive problems than the securitization markets, partly because traditional covered bonds have a much simpler structure. This makes the overall market more transparent and the valuation and risk assessment much easier. Covered bonds also have a much stricter regulatory framework. And overall, there have been problems in the securitization market that relate to the opacity and misaligned incentives. These need to be addressed, they can be addressed, because we need a revival of these markets, of course, for the future. I would now conclude by recalling not only the exceptional speed with which the crisis hit the financial sector, but also the unprecedented size of its impact. If we look at one example, the interbank markets, for instance, they are usually among the most liquid in the financial sector. In 2006, for instance, the daily turnover in the euro money market was about 140 billion euro. This 140 billion source of funding dried up within very few days. You see now on this chart the spread between the 3 months unsecured rate and the 3 months overnight index swap rate, which is a standard measure of interbank market tension. Until August 2007, which is often said as the beginning of the financial crisis, unsecured euro interbank market had a spread of around 5 basis points. After the announcement that one of the major European banks would freeze some of its funds, the spread increased by a factor of 12 to around 60 basis points. And after the collapse of Lehman Brothers and the events surrounding the last weekend of September 2008, the rates shot up further, eventually reaching a maximum of 186 basis points. And this is also mirrored by the amount of funds deposited with the ECB at that time. So banks were preferring to deposit liquidity with the ECB instead of lending to each other. The events of the last 2 years have not only shown that even the most liquid funding markets for banks can seize up within days, but also proved that long-standing economic relationship across different market segments can break down suddenly. Therefore, future regulation has to take into account the liquidity risk, and it will also prescribe sound liquidity policies. Recent international evidence suggests that banking strategies that rely primarily on generating non-interest income or attracting non-deposit funding are very risky. And this is also shown by an interesting research from Andrea Beltrati from Bocconi University and co-authors which suggests that those banks that performed better prior to the crisis were also facing the crisis in a much more intensive way. And on the first side, profitable strategy of a bank can turn out as a very risky one and turn very, very quickly into huge problems. And therefore, banks in countries with stricter capital requirements and more independent banking supervisors seem to have performed significantly better during the crisis. It was also mentioned by Mr. De Felice. And also banks with more Tier 1 capital and in countries with more restrictions on banks' activities have also done relatively well in recent quarters. Now, what have we now learned from this crisis so far? First of all, it's important that the structure of banks' liabilities is appropriate for the structure of the assets they are holding. Banks have been excessively leveraged relative to the risks they were taking. Second, we still know too little about why banks hold different levels of equity. We do know, however, that ultimately equity is the only robust buffer against realizing losses. Also, holding equity is costly. Bank capital regulation should also take into account macroeconomic implications of bank capital requirements. And we are only at the beginning of understanding the interrelation between these two pillars of policy making, so to say. Third, banks to a large extent ignored the role of deposit as a stable source of funding. More and more assets were funded by non-deposit liabilities. What is important that banks turn to a more sustainable source of funding in the future, namely long-term financing. Banks turned excessively to the wholesale market, and this has been a big risk. Fourth, owing to its potential benefits, innovation, of course, will continue, but there will be maybe a huge effort also in the direction of reduction in the level of complexity and leverage of the instruments. Fifth, I would also like to say a few words on the macro-potential aspects of financial stability. In Europe, we are now in the process of designing a new framework for macro-potential and systemic risk prevention. It's important to develop a framework in an environment where many supervisory agencies and also other financial institutions are involved. It's a complex undertaking, but it's very important to succeed in this respect to address systemic risks in a very much more preventive way. We can say that the authorities have taken action. I would also like to underline that Governor Draghi plays a very important role also in leading the debate on some of these issues in the international fora. And there seems to be an agreement now, first of all, at the international level, to introduce a leverage ratio as a measure to curb banks' excessive balance sheet growth. The measure will be introduced initially as a supplement to the Basel II risk-based framework and subject to proper calibration and review as a minimum regulatory requirement later on. Second, there's an agreement to raise the quality, the consistency, the transparency, and the level of capital, namely the amount of common equity and other instruments of equally high loss absorption capacity. Third, there's agreement to introduce a framework for counter-cyclical capital buffers above the minimum capital requirement, which will be raised during economic upturns and be used during the downturns, and as well as to promote more forward-looking provisioning. And fourth, there is also the agreement to establish a minimum global standard for funding liquidity, which includes a stressed liquidity coverage ratio requirement and a longer-term structural liquidity ratio. The measures will be introduced by the end of the year, and they will be phased in as financial institutions improve their overall position and as the economic recovery is assured. Measures to address the misalignment and the lack of transparency of incentives in the securitization market include strengthening the capital requirements for these exposures and introducing better risk management practices and disclosures. These measures as well will be implemented in the course of next year. And it's important also as a precondition to revive the securitization markets. Three important institutions, the IMF, the Financial Stability Board, and the BIS, will provide guidance on identifying systemically important institutions, markets, and instruments. They will issue a report in November of this year. And I will come to my conclusion by saying that I tried to describe how banks are special, why they are special. We have seen during the past 2 years, when the financial system fails, the whole economic system is affected. We have seen that the financial sector has undergone an unprecedented wave of innovation, change, and transformation, and recently crisis and stress. We have now a better understanding which of the business models do not work, but there are still many open questions to be addressed. We will see in the future, hopefully, capital requirements which provide better loss-bearing capabilities and also have less procyclical effects on the economic system, but there's still a lot of work to do to fine-tune the new requirements. There's also a lot of work to do to fine-tune the future compensation and corporate governance principles, which should support the long-term value creation of banks. And we also have to address the issue of how can risk management practices and risk pricing models better represent possible gains and losses, not only short-term results. There is no simple answer to the issue of what is best practice for banks' business models, but what is sure, we need research. We need your contribution in the end to improve the stability of the financial sector, which is so crucial also for the economic prosperity in the future. Thank you.